The term insurance for short measure originated over 1,000 years ago in England to make sure customers came out whole. Back in those medieval days, baked goods were sold in allotments of a dozen. The problem with those old brick-fired ovens, whatever baked goods that were closest to the fire crumbled, got burnt, or disintegrated. In order to rectify the problem and make sure customers came out whole, an extra baked good, 13, was thrown in, coined the term baker's dozen to insure against short measure. 1,000 years later, almost to the year, lenders found themselves in a similar predicament when Congress made it unconstitutional for lenders to charge prepayment penalties. Not only did lenders anticipate less income from not being able to charge prepayment penalties, yet saw the congressional action as devastating to their bottom line, opening floodgates for all borrowers to accelerate their loans. Rather than calculating interest on the same schedule that borrowers pay interest on, 12-month cycles, lenders came up with a brilliant idea of calculating interest on faster, shorter cycles, 13-month cycles, so they could get one additional month of interest a year out of unknowing borrowers as their way of making up for not being able to charge prepayment penalties. Thus, lenders calculate mortgage interest on the same cycle that payroll departments make biweekly payroll on, 13 28-day cycles, yet receive payments on the same cycle that payroll departments make semi-monthly payroll on, 12 30.5-day cycles. One would think 6 of one, half a dozen of the other. Since both cycles have 365 days and 52 weeks, it would seem like it doesn't matter which cycle interest and payments are calculated on. Yet it makes all the difference in the world, such a big difference that it can make the difference between you being rich or poor. The difference where payroll departments deposit those extra days beyond the 28th of each month into your checking account, once at the beginning part of the year and once at towards the end of the year, lenders add those extra unpaid days to your already huge outstanding balance. Rather than protecting the consumer like bakers did, lenders are protecting themselves as the extra days that make up to the 13th month default to them as their insurance for short measure. To ensure that they keep the spread between the two cycles, the 13th month, as their insurance for short measure, lenders have made all payments after 12 optional, not requiring any notification that they are due or late. Most borrowers don't even know that lenders calculate interest on 13 28-day cycles, continuing to make payments on 12 30.5-day monthly cycles. To keep borrowers from catching on to this accounting nuance, lenders have made it policy to not accept payments from borrowers on the same algorithms that they calculate interest on. However, borrowers can accomplish the same result using third-party administrators like the Biweekly Mortgage Association to debit their accounts biweekly and pay their lenders on the same frequency that interest is calculated on. This easy and inexpensive process will save most borrowers tens of thousands of dollars in needless interest payments while owning more of their home sooner. If you like what you've just seen and heard, hit the thumbs up button and be sure to subscribe if you would like to see more of this content. Thank you very much for viewing.